The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Ben Boulos. These are your headlines. Oil prices sink as President Trump flags fresh Iran talks today, pulling back from the threat of a massive strike after pressure from regional allies.
We're all set to go, but when the allies ask to call it off, you got to sort of say, well, let's see. And the reason they asked is I think there's a deal. There's a deal on Hormuz, and then there will be a deal on the nuclear.
Well, that news boosts US and European futures ahead of the first trading session of the new month, while in Asia, the yen seems to settle after an earlier surge, with US and Japanese authorities confirming market intervention. And reports swirl of talks between AstraZeneca and Bristol Myers-Squibb to create a $400 billion pharma behemoth, potentially one of the sector's biggest ever deals.
President Trump has said new talks with Iran will resume today after calling off what he said would have been the biggest attack since World War II on Saturday. The fresh round of talks is the latest effort to de-escalate the six-month conflict and return to the negotiating table following the collapse of a ceasefire and memorandum of understanding signed in mid-June. Speaking to reporters aboard Air Force One, Trump said key Gulf allies had urged him to hold off on strikes and pursue new talks with Tehran.
I was asked to by Saudi Arabia, by UAE, by Qatar, and by Iran. We were all set to go just about at this time right now, and it would have been a massive attack. We were all set to go, but when the allies ask to call it off, you got to sort of say, well, let's see. And the reason they asked is I think there's a deal. There's a deal on Hormuz, and then there will be a deal on the nuclear, or you might call it the denuclearization of Iran. I call it the denuclearization of Iran. So we're holding it. We'll just see. We can do it anytime we want. But we were asked by the three primary groups. We were also asked by Iran, very strongly, actually. They said, we'd like to make a deal.
Well, in a state media post on X, Iran's acting defense minister called Trump's latest move, quote, part of a psychological and cognitive warfare campaign. Well, Tehran's state news agency, Fars International, described Trump's ceasefire demands as a, quote, wish list. And in around 15 minutes' time, we will discuss the outlook for the oil markets with Neil Atkinson, former head of oil at the IEA.
Japan has confirmed a joint intervention with the US to support the yen. The move comes after the currency dropped to its weakest level since 1986 last month. According to the Financial Times, the Federal Reserve sold euros in order to buy yen on behalf of the US Treasury. President Trump labelled it a sign of friendship. And we are seeing some dramatic moves on the back of this intervention. You can see very much in terms of how swiftly there has been a drop in the dollar versus the Japanese yen. 156 the handle, that is what we're watching very closely. And of course, consequences on other currencies as well. 115 is what we're seeing, perched slightly high for euro, the opposite for sterling. But that yen is certainly the one to watch at this hour. And whether there's any more moves, suggestions are, look, the fundamental weakness that remains in the Japanese yen as a catalyst, that's still the underlying here. But obviously, speculators have been impacted very much by this intervention, swooped in and, of course, surprised many in the markets. And let's get to what we're seeing across on those Asian markets and how the region is faring as we kick off the Monday trade. Japanese stocks are sliding. We've got a drop here, 1.2%. Obviously, when you have such a large fluctuation in one asset class on the currency front, it can have some bearing on equities. Some suggestion here too, but what it means in terms of pushing the BOJ towards a rate hike that could be imminent, come through September. So the market also looking at the consequences of that. Elsewhere, Hong Kong is fairly flat. You've got Japanese stocks and Chinese names along with South Korea, all in reverse. The South Korea market, though, showing the biggest swings today, down more than 5%. Let's get to US markets, because it was actually some moves in tech names that was also supporting the market stateside. We saw a bounce in Amazon stock that carried the S&P 500 forward in the Friday session, 7/10 high. But the big moves by Amazon, really the catalyst for the Dow and the Nasdaq as well. As we look to get going this morning, you can see we're chasing more upside here. Got the Nasdaq seen up about 1%. But the other big feature, the US Federal Reserve, and just what bond yields have been doing in the backdrop. And let's get to European futures. At this hour, we are chasing a stronger picture. It looks as though we'll have a fairly decent start this morning. The DAX are set to pop by more than 1% as well. Now, those US futures, the early indication, this is what it looks like stateside. And you can see we are called to reinforce some of those gains that we saw in that Friday session.
Let's focus in on the South Korean market, because the Kospi trading firmly in the red this morning, currently off by more than 5.5%, after closing out its best day ever on Friday, driven by mammoth moves to the upside from the usual suspects. SK Hynix, which surged as much as 30% on Friday, and Samsung Electronics. But it is a real testament to the volatility we've seen over the last month that even with that record jump on Friday, that record move, the index still closed lower on the week. It closed the week around 1.4% lower. In addition to that, posted its biggest monthly fall since October 2008, down more than a fifth. But it's also worth mentioning that despite all of that volatility, all of the falls, so far year to date, the Kospi is still up more than 50%. A lot to digest there.
So where does it leave the Nasdaq? Well, it comes as the Nasdaq 100 suffered its steepest monthly decline in more than a year. The tech-driven benchmark falling roughly 7% in July, the most since March 2025. It was eventful, though. Intel, SpaceX and Tesla all contributing heavily to the losses. Intel and SpaceX off about 35% in July, while Tesla lost around a quarter of its value. Let's make sense of this with Cyrus Miwawala, who is the head of strategic intelligence at Global Data PLC. Cyrus, thank you so much for joining us.
Thanks, Karen.
Now, I peeled away from the set about 2 weeks ago to go on holidays, just as markets were starting to tank in technology. There's a lot of bumpiness already starting to materialise. And it seems like we've been buying back over the past number of sessions. Some of the evidence that we've had from earnings season has supported the chip story. What do you make of the bigger picture here, and whether there are dangers around technology stocks?
So I think investors are incredibly jittery, and they're jittery because let's look where we are in the AI cycle. So in November 2022, ChatGPT launched, or OpenAI launched ChatGPT, and that's when this race started that we're looking at here. And since the 3.5 years since the start of 2023, the big four hyperscalers, Meta, Amazon, Google, and Microsoft, have invested heavily. They've invested about $1.1 trillion. This year, they're expected to invest about $750 billion. So investors are getting jittery because they're not seeing AI revenues. But these results from last week showed us two diverging sets of big tech players. The first is Amazon, Microsoft, and Google. They are accelerating their cloud revenues. A lot of those cloud revenues are coming from pure play AI models like Anthropic. But then on the other hand, you saw Apple and Meta, their share prices fell. They fell significantly for two big reasons. One is neither of them are selling cloud services separately, and both of them are struggling to give the world a set of AI services.
So how do we think about placing bets from here? Because one of the big stories that I think is undermining confidence has been the huge swing we've seen in some of the semis, the DRAM stocks, and we know there's been a ton of leverage. So as soon as you see any selling, it gets exacerbated by that leverage on the downside. How do we think about those particular names and what comes next there?
So in the short term, I'm reasonably confident that we're not going to get some kind of crash. And the reason I say that is this accounting term called remaining performance obligations, which were quite high. And what RPOs mean is Microsoft, Amazon, Google, how much contracts have they got that they haven't yet delivered on cloud? And for Microsoft, the figure was enormous. It was something like $678 billion. That's almost 2 years of revenues. For Amazon and Google, it was roughly $500 billion each. And what that means is they've got 2 years of contracts still to come in that they have to deliver. So there's no immediate issue with demand for AI, although this is mainly demand for cloud services. But for those companies that are not providing cloud services, like Meta and Apple, it could be an issue.
So you're saying semis are a buy after the sell-off? So
I'm saying there's no, for me, there's no immediate risk to semis, but there are many, many other risks to the AI system. They are, for example, the circular nature of trades. So if you look at the AI ecosystem, you've got chip makers like NVIDIA and AMD, you've got neoclouds like CoreWeave, you've got the hyperscalers and the data center makers, and everybody's got a little investment in somebody else, and that investment is conditional upon those people buying maybe their chips or something else. So a little, just a small blip could send the whole pack of dominoes down. And we saw what happened with Situational Awareness, an AI hedge fund. They invested in AI infrastructure stocks, mainly hardware. They over-leveraged, and then Citadel had to come in and save them.
Cyrus, I just wonder, we're seeing a real divergence. I mean, there's a real kind of drilling down now into the type of tech stocks. I mean, look at last week, Microsoft, the top gainer on the Dow. I know you own Microsoft stock yourself. Yep. It was up almost 25% on the week. At the other end of the scale, on the S&P, you've got Intel and SanDisk as some of the biggest fallers. SanDisk closed the week 46% down, Intel down 35% on the week. What does that tell us about the way investors are scrutinising the AI trade and really not just seeing it holistically as anything tagged with AI is exciting and there's momentum behind it, but really differentiating between where they see there's real value and growth and where there isn't?
I think investors are waiting to see if we're in an AI bubble that's going to crash. I think these RPO numbers told them that we've still got some way to go before it crashes, and then they're looking at who are the critical chip makers involved here that this AI boom still needs, and they are NVIDIA, who provides the GPUs for this compute power, and also some of the memory makers like Samsung, SK Hynix. And Micron.
I just want to get your thoughts on the Korean market in particular. The volatility has been extraordinary. I mean, if you get travel sick, that is one market not to be riding. Yeah. But I just wonder, when we saw the Korean authorities step in towards the end of last week and say they will ban any new single stock leveraged ETFs, that's all very well in terms of trying to put a dampener on the volatility. But if these companies have relied on people borrowing to then invest in these companies to help fund their growth and their build out and their expansion, what happens to those companies then if that source of funding is potentially no longer there?
Yeah, I think that's a big issue. The circular funding thing comes into that. If you look at the big hyperscalers together with Oracle and others, they've borrowed more than 1.6 trillion. A lot of that is not directly from the banks or from bond markets. They're from the shadow banking sector. So I think, yeah, a lot of these things could trigger a collapse. It's very tense right now for these outside reasons.
Is OpenAI the big risk? I mean, I spent all holidays reading about the background and how it started, and its thirst for large language models, but also getting to AGI first. Yeah. This is like the whole motivation for the business. And obviously we still feel like we're some distance away from AGI, but still with deep investments required, capital markets that need to keep on funding this type of investment at the same time when bond markets are now concerned about the US Federal Reserve and whether the central bank has its handle on price stability. So is OpenAI potentially the root cause of some of the issues if it doesn't get to where it's going quickly?
I think OpenAI is very far from profitability. If everybody has billions of AI agents and AI robots, the future's bright for OpenAI. But right now, it's a one-bet company. It doesn't have cloud services. It doesn't have Google search or whatever. It's just got to sell its AI model. And it's got a number of risks. The first is Chinese open source models are cheaper. And some of them are really, really good, if not better, than the frontier models in the West. The second is the pricing structure. So OpenAI, like Microsoft and others, started by pricing it on a per-seat basis, but then people used too many tokens, they were making a loss, so now it's on a per-seat plus consumption basis. But our company is going to continue paying heavy heavy prices for tokens when they can get it cheaper elsewhere.
Yeah, open source too in the United States as they try to take on some of the Chinese competition. That could be another big threat as well. Cyrus, thank you so much for joining us. Cyrus Mimawala with us, Head of Strategic Intelligence.
Do stay with us. Still to come on the show, July jitters. Higher costs and weakening demand take a bite out of China's manufacturing activity as supply shocks ripple across the global economy. Plus, a $400 billion pharma mega deal. Reports swirl of talks between AstraZeneca and Bristol Myers-Squibb in what could potentially be one of the sector's biggest ever deals. And running out of time, OPEC Plus hikes output for a sixth consecutive time. Former head of oil at the IEA, Neil Atkinson, joins us next.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's Miss Jo Malone at CBE.
I started that first business of skincare. That's when I knew that I was in charge of my own life. And that's when the entrepreneur really, although I didn't know what the word entrepreneur meant, that's when the entrepreneur really took hold.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
Welcome back. OPEC and its allies have agreed to raise oil production for a sixth time in a row, finishing a phased rollback of a 1.65 million barrels per day supply cut that was originally agreed in 2023. The seven-member alliance is likely to increase its output target by a further 188,000 barrels a day next month. This is according to two delegates speaking before the video conference on Sunday. Well, speaking on Friday, Chevron CEO Mike Wirth and Exxon CEO Darren Woods reiterated the importance of getting supply back online in the Strait of Hormuz.
That resource in the region has to get to market. The strait has to open up. It is the main artery of supply for the world that powers economic growth everywhere. And so eventually those barrels are going to have to flow. And the only question is how long will it take to get to some resolution here so that the strait opens up and that production can come back on in the Middle East. But I think, medium to long term, the world needs that resource. And I think governments will find a way to make sure that resource is available to the world.
We've seen some of these buffers help with supply. That's bought time, but it hasn't resolved the fundamental issue that we've got disrupted flows in the Strait, now in the Red Sea. There's been some issues in the Black Sea. And so the system remains under a lot of stress. And it's been really important that the U.S. has been as a key a supplier and able to help the rest of the world mitigate outages on both products and crude oil.
Let's get the thoughts now of Neil Atkinson, the former head of oil at the IEA and visiting fellow at the National Centre for Energy Analytics in Washington, D.C. Neil, always good to have you with us, and thanks for being on the programme. With this announcement of the OPEC Plus decision to increase supply output, is it anything more than symbolic, given the fact that the status of the Strait of Hormuz, it's almost impossible to say what condition it will be in come September?
Well, yes, and it is mainly symbolic because at the moment, as we all know very well, normal supplies through the Strait of Hormuz from members of OPEC Plus, Saudi Arabia, Iraq, Kuwait, Qatar, UAE, those supplies are significantly below normal levels, and so we are not in a normal market. So OPEC's decision is mainly symbolic. And of course, we should also remember that OPEC Plus is now minus the UAE. So any decisions that the new OPEC Plus takes needs to be considered in light of the fact that a very important producer is actually no longer part of that grouping.
Yeah, I was going to ask you about that. Given that the UAE has now pulled out of OPEC Plus, do we know what position it will be taking and how its moves unilaterally might affect the oil markets?
Well, I believe for a very long time that based on the huge investment that's taken place in the UAE, particularly in Abu Dhabi, because of the investments made by ADNOC, that ADNOC has been adding capacity pretty well everywhere along the energy value chain. And if you add capacity, you're intending in the long run to use it. And the UAE is adopting a far more commercial strategy than was the case when it was a member of OPEC. And when normality resumes, whatever version of normality resumes vis-a-vis the Strait of Hormuz, the UAE and ADNOC are going to act aggressively to build and expand their market share to the maximum extent that they are able to do. And of course, they will no longer be constrained by any obligations in terms of an OPEC quota.
Neil, good morning to you. It's Karen jumping in. I want to get into that new normality and whether we could be getting to any sort of a resolution. It feels as though a lot of partners in the Middle East are concerned about the duration of this conflict, that the ceasefire disappeared and we're talking about a massive strike that has been averted. What do you make of any headway that can be made from here in short time?
Well, it was notable that at the conclusion of the OPEC Plus meeting in their communique, there was actually, I think for the first time, a pretty direct reference to the consequences of the closure of the Strait of Hormuz. And those remarks could be obviously seen as being directed towards Iran, which is a member of OPEC, although not a country that's bound by a quota. So that they are concerned because they have been directly impacted by missile attacks from Iran. Their infrastructure has been damaged to varying degrees. They're unable to get their oil and gas out into global markets. And of course, those remarks are also directed against the United States because, you know, as far as those countries are concerned, they need a deal soon to allow normal operations to resume. Because without it, you know, their economies are suffering, their revenues are suffering, and, you know, they want regional peace like we all do.
Yeah, you get the sense that they want to get on with business soon and that this process is taking way too long. Neil, let me ask you then about the Saudis and what they do from here, because they had been redirecting some of their oil exports, but then some of those redirected that product was under pressure then from the Houthis a couple of weeks back. How is the Saudi machine going to re-gear itself for the future to future-proof itself?
Well, there's no doubt that the Saudis and indeed others, including the UAE, are looking very, very seriously at reducing their reliance on the Strait of Hormuz long term, whether there's a peace deal in the near future or not. They realize that this is a huge vulnerability. There is not likely to be any significant change in the regime in Iran in the near future. So the Saudis are going to increase the capacity to shift oil across to the Red Sea, to Yanbu, and to export from there. And they'll look at other possible opportunities to reduce reliance on the Strait. And that applies to the UAE, which has already, of course, expanded its shipments out of Fujairah, which is outside of the Strait. And other countries will look to look for new export opportunities as well. And we may see regional cooperation, countries in the Gulf Cooperation Council working together to make investments to expand or to build new export opportunities. But this is an existential situation for Saudi Arabia, because to be cut off from the Strait of Hormuz is bad enough, but also to be threatened by the Houthis out of Yanbu is another huge problem. And that is perhaps something which hasn't been as widely discussed as the Strait of Hormuz situation.
Neil, this middle of the summer season in the Northern Hemisphere, key time for school holidays and travel. We were warned that if the disruption continued, by this point we could see physical shortages of jet fuel. I haven't seen anything to suggest that, you know, airlines are struggling to get hold of it, or that the price has gone so prohibitively high that it's affecting demand through higher fares. Well, what is the situation with jet fuel right now?
Well, to some extent, the airlines will have hedged, but the main point here is that, yes, of course, the Strait of Hormuz crisis has led to a huge decrease in the availability of crude oil and products. But the offsets that we've seen, higher exports by Saudi and the UAE from other export outlets, huge exports from the United States, which should not be overlooked. U.S. crude and product exports have hit 13 million barrels a day at times since the crisis started. The fact that the market's been helped by China not attempting to replace lost Gulf barrels, and demand destruction in some of the Asian economies. So we've seen that the net impact of the closure of the strait has not been as bad as where we first thought when the crisis started at the end of February. And that has obviously had its impact on product markets, whether it be for gasoline or diesel or jet fuel, shipping grades, which is not to say that the prices aren't high, because oil product prices are pretty high. We focus always on crude oil because that's the number we're familiar with. But diesel prices over $150, $160 a barrel, including jet grades. So yes, the supplies have been maintained. We haven't seen mass flight cancellations. We haven't seen huge increases in ticket prices. But we should thank our lucky stars that we have managed to avert the worst of the situation for this year's holiday season.
Yes, and that point about diesel, it's something that one of our guests coming up later in the programme has flagged in his notes. But it is really interesting, isn't it, that the variation we're seeing in the different grades of oil and how that is. Just tell us a little bit more about the significance of that differentiation with diesel in particular.
Well, diesel is essentially the workhorse of the oil economy. Every country in the world uses various diesel grades, whether it's in trucking or shipping, in industrial applications. Diesel is pretty central. And in the United States, we tend to focus on gasoline prices because that's a sort of sexy political metric, being over $4 a gallon. Diesel prices have been well above $5 a gallon, heading towards $6 a gallon in the United States for some time. And that has a direct impact on trucking, moving goods and services around, or moving goods around. It has a direct impact on shipping because shipping uses various diesel grades. So diesel is the workhorse of the global economy, and its price being as elevated as it is a danger signal for the global economy, because in time, if those prices are maintained, that will have a negative impact on the global economy. So it's good that you've raised that point, and it's something which I think is going to become more and more obvious to people as time goes by without a resolution to the underlying conflict.
Neil, when we talk about politics, and let me bring up the oil and gas fields closer to home, because we've had a whole conversation about what the Saudis do for the future to ensure its revenues are stronger. The UK has been embarking upon a lot of soul searching too as to whether the North Sea field should be explored further from here. And there's been a push from the likes of Shell for this to happen. Others in the industry say take off the windfall taxes, allow us to explore this much closer to home facility when you've got so many geopolitical challenges. Now BP is hanging up the for sale sign on those North Sea assets. Does any of this make sense to you?
Well, does anything political make sense? Look, across the fence in the North Sea, so to speak, you have Norway. Now, Norway has been allowing lots of exploration for many years. It's maintained a significantly higher level of production than the United Kingdom. It beggars belief that on the UK side of the divide, there are not exploration opportunities that companies might want to take advantage of. Now, the tax issue is obviously a key part of that. The political background is a key part of that. And I believe that because I believe that global oil demand is likely to rise for years to come, and we're going to need plenty of supply, the UK, even though it will not be a massive contributor, will still be a contributor to global supply. That is good for global security of supply. And I hope that the new British government adopts an attitude where it says to the oil companies, even if it isn't BP, it says to the companies, look, there's the North Sea. You have new technology to use in exploration efforts. Here's a financial or fiscal incentive for you to go ahead. Go ahead, have a look, see what you find. And if there is the possibility of UK production starting to tick up again in the future, I think we should welcome that.
Well, Neil, a fiscal incentive versus the fiscal punishment that they've got currently would be a huge change. Thank you so much for joining us today. Neil Atkinson with us.
My pleasure.
Former head of Oil, IEA, and visiting fellow National Centre for Energy Analytics, Washington, DC. A quick look at how futures are shaping up ahead of the start of the European trading session this morning. We are perched high. Looks like a firm start for the German stock market.